Companies that regularly pay out a percentage of their earnings to a class of shareholders are known as dividend stocks. These businesses are often well established, with consistent earnings and a history of returning a portion of those earnings to shareholders. Dividends are paid out in the form of cash or more stock and are known as distributions. Most dividends are paid out quarterly, although others are paid out monthly, annually, or even once as a special dividend. While dividend stocks are noted for their consistent dividend payments, dividends may be reduced in adverse economic times to conserve cash. Hello, this is Upstep Financial, and in today's video, we'll discuss the top 10 dividend stock picks for 2021. But before we go any further, if you want to raise your financial game, subscribe and hit the notification button to be notified of each new upload. Adobe Inc., ticker ADBE. Adobe has outperformed the market, with a market capitalization of more than $300 billion. The gains in 2021 were primarily fueled by Adobe's excellent fiscal second quarter earnings released in June. Revenue and non-GAAP earnings per share increased by nearly 23% year over year, outperforming analyst projections. Adobe's services are primarily based on its digital media business, which produced $2.8 billion of the $3.8 billion in revenue last quarter, making it a practically essential investment for professional and amateur creatives of all types. Adobe's Creative Cloud, in turn, is a driving force in digital media, with a recent subscriber growth in tools like Lightroom and Photoshop, helping the company achieve a strong quarter. With an increasing number of loyal returning clients, the company remains an appealing, high-margin software business. Spotify Technology, SPOT. On the other hand, Spotify has been a disaster, ranking last on the list of the best stocks to purchase in 2021. The company is currently in good shape, but recent quarters have seen it fall short of market expectations. The company added 9 million monthly active users in the second quarter, bringing the total to 365 million, which was lower than the previous quarter's projection of 366 million to 373 million. Spotify's margins are increasing, thanks in part to its bets on podcasts, for which the business doesn't have to pay per-spin song licensing fees. A relatively new feature in Spotify's fledgling discovery mode that allows musicians to pay for promotions is another potential driver in the coming quarters and years, with artists in discovery mode gaining 40% more listeners than in their pre-discovery mode days. Investors that are patient should remain with SPOT. BJ's Wholesale Club Holdings Inc. BJ. The rationale for BJ's being selected as one of the top stocks to purchase in 2021 was straightforward. During an extended pandemic, cost-conscious buyers appeared to be on the lookout for bargains, favoring bulk stores like BJ's. BJ's is also significantly less expensive than Costco Wholesale Corp, or CSOT, which had a price-earnings ratio about 3 times that of BJ's. BJ's is the second best performer on our list thus far, but it still trades at a significant discount to Costco, with BJ's stock trading for 18 times earnings versus 41 for Costco. BJ's is slowly expanding, with 6 new warehouses planned for this fiscal year. The Walt Disney Co. DIS. The Burbank, California-based entertainment behemoth is still one of the more dependable blue-chip stocks on this purchase list, despite a poor performance in 2021. As a result of the epidemic, Disney's renowned parks were forced to close or operate at reduced capacity, and its cruise line business was forced to cease operations entirely. On those fronts, things have been improving, with cruises gradually resuming in August. The Delta variant poses a clear threat to its parks, experiences, and products sector in the short term. At the same time, the relatively new Disney Plus streaming service has been fast increasing, with subscribers more than doubling year over year, 103.6 million in the second quarter. Investors can be confident that Disney's streaming stakes in Disney Plus and Hulu will function as a hedge if COVID-19 variations force it to close down parts of its business once more. We've made it halfway through our list. Please give this video a thumbs up and share it with your dividend stock-loving pals. Facebook Inc. FB. On the Earth, there are an estimated 4.7 billion active internet users. Facebook's dominating family of businesses, including its eponymous app, Messenger, Instagram, and WhatsApp, has 3.51 billion monthly active users. So far in 2021, Facebook has outperformed the market, with revenue increasing 56% year-over-year in the second quarter. Despite being a behemoth with a market capitalization of $1 trillion, Facebook still prioritizes innovation. The corporation is a pioneer in artificial intelligence research, has ambitious to integrate e-commerce services into Instagram, and is working on a long-term aim to construct the metaverse, a massive virtual world in which people digitally live, work, and play, according to the CEO, Mark Zuckerberg. Alibaba Group Holding Ltd. (BABA). Alibaba's prospects have been severely harmed this year by an external factor, the Chinese government. Along with Tencent and JD.com, Alibaba is one of many significant digital companies that Chinese regulators are taking antitrust action against, JD. In addition, late last year, Alibaba's fintech unit, Ant Group, had its initial public offering cancelled. No word on when it could be revived. And in April, China fined Alibaba a record $2.8 billion for alleged anti-competitive activities. However, it's not all bad news. Despite its massive size, BABA continues to grow at a breakneck pace, with revenue up 34% year-over-year last quarter. So long-term investors who believe China's regulatory drive will subside over time have an excellent opportunity to buy now when negative sentiment puts downward pressure on the stock price. Lowe's Costs Inc. LOW. Lowe's, the home improvement retailer, is just a well-run, rock-solid company with bright future possibilities. Despite a year-to-date gain of more than 19%, shares trade at a low 16 times ahead earnings, over 30% lower than larger rival Home Depot's, HD. Forward PE of 22.5. Home renovation stores are booming with a hot property market and a spike in do-it-yourselfers patching up their all-too-familiar dwellings during the epidemic. This is reflected in the company's financials, with comparable stores sales climbing 25.9% in the April quarter. In addition, Lowe's purchased back $3.1 billion of its stock and paid $440 million in dividends in the fiscal first quarter, always keeping an eye on returning capital to shareholders. Lowe's, a dividend aristocrat that has increased its dividend payout annually for more than 25 years, has the considerable financial freedom to continue boosting its dividend, which presently yields 1.7% annually. Nautilus Inc. NLS. Nautilus, dubbed the poor man's Peloton, is a home fitness equipment company that owns several brands, including Bowflex, Schwinn, and the Nautilus range of goods. Nautilus has already reported 2 consecutive record-breaking quarters to start the year, with sales up 81.7% and 119.9% year-over-year, respectively, heading into August's earnings release. This expansion rate is unsustainable in the long run, as demand for home workouts and linked fitness equipment should level off when the pandemic subsides and gyms become a more viable choice. This year, the stock's decline is attributable to exaggerated expectations that Nautilus failed to satisfy earlier in the year, but the bar now appears to be relatively low. Nautilus is valued at 8 times forward profits, but after deducting $3.58 in cash, its forward PE is closer to 6. With a market capitalization of around $450 million, Nautilus is the most minor and most volatile firm on this list. Nevertheless, it is still appealing at these levels. Sonos Inc. SONO. Sonos, the elegant speaker firm focused on the expanding market of the connected home, a subset of the much wider Internet of Things phenomenon, is the top year-to-date performer among the best companies to buy for 2021. Similar to the thinking behind Lowe's decision, the theory with Sonos heading into this year was that consumers would be willing to spend money on cleaning up and renovating their homes during a time of work-from-home regulations and shutdowns. As a result, Sonos has now had 2 consecutive record-breaking quarters, with year-over-year revenue growth of 15% and 90% respectively, heading into its following earnings announcement. In addition, Sonos' fiscal 2021 estimate was recently raised, assuming that it will account for only 9% of the $18 billion premium home audio market, allowing it lots of room to grow in the years ahead. Newmont Corp, NEM. Newmont tends to be a strong hedge against uncertainty as a gold and copper miner, which has been prominent since the pandemic began. Newmont's year-to-date performance has been disappointing, mainly because gold is down around 8% in 2021. Suppose the Delta variant continues to cause mayhem in the United States. In that case, the precious metal, which is considered a haven in times of market volatility, may begin to thrive once more. But if the rest of the year is smooth sailing, anticipate NEM to underperform. Newmont's 3.7% dividend yield, the highest on this list, will appeal to income investors. That concludes today's video. Would you please subscribe and click the notification button to be notified of new uploads?